Materiality. Somebody give us the definition that you guys have in your notes. The year end, like the date, is a point in time. So the year would end at December 31st after 11:59 p.m. That's year end. So January 1st would be the beginning of the following year. Materiality, you said an amount or likelihood is very likely to influence the financial statements or the end user's decisions. What else? What's another acceptable way to define materiality? But what is that emphasis though? What makes it material or not material? That is, put it all together, that is likely to influence, right? So materiality has to, if we said information was material, what's another word that we could substitute instead of material? Important, right? Because it matters to the end users. So some of the things we say in class is material to your test, right? It's important. You should know that. Some of the things we say may not be material. I like to think that all of the things I say is. So let's kind of understand this whole materiality thing in terms of the financial statements. Why is it that immaterial misstatements or immaterial errors or inaccuracies are even allowed in the financial statement? Yeah, so even if we don't take the auditor out of this sentence or this discussion, why are some inaccuracies even allowed in the financial statements? Well, putting it all together, it wouldn't be worth it to chase down certain inaccuracies if they didn't matter to someone's, right? The time, the cost, the effort that it would take to ensure 100% accuracy would not, the cost benefit wouldn't be there for the end user. So as they say, someone stated plainly, it doesn't affect the end user's decision, right? It does not matter. And as Ruby mentioned, tracking that stuff down would delay the issuance of the financial statements. Then that information in the financial statements wouldn't be timely because we're chasing down pennies. So there's this idea of materiality because the cost to find and correct certain things is just too high compared to whether or not it's useful to the end user's decision. When we talk about materiality, Jose mentioned for us that it's usually a dollar amount or a percentage of some important account on the financial statements, like a percentage of current assets or net income, things like that. There's what we call a rule of thumb. A rule of thumb means that it's typically, like we just said, some percentage. Each professional services firm is going to have their specific calculation for materiality, taking into certain factors. But if you look in your book, right, it helps you out with certain calculations, right, and understanding that. We're not going to do calculations in this class, but it helps you kind of understand that. There also is what's called a cumulative effect. Let's say that you've established for the accounts receivable account, any account over or misstatement over $1,000 is considered material to that account. Well, what if you had a bunch of accounts that were like $900 off? Not 1,000, but 900, or 1,000 accounts that were $10 off. There's a cumulative effect to materiality too. Why? Because remember when we talked about the objective of an audit, we said as a whole, that the financial statements as a whole would be free from material misstatements. So the auditor also has to look at the cumulative effect of materiality. Like if we take a series of immaterial misstatements and add them together for a specific account, would they end up being material, right? So you do look at that as well. And then there's also what's deemed the nature of the issue. When we get into the fraud chapter and we talk about Wells Fargo, some of us are going to argue that the nature of the problem, even though it was immaterial to the financial statements, the nature of the issue, that the nature of the frauds was material, right? And so sometimes it might not be the dollar amount that makes something material. No, all of the above is correct. Each one of them can be a dollar amount, or it can be a percentage, it could be the nature of the issue, and it can be a cumulative that makes something important to the end user's decision. But some of us are going to argue for and against materiality when we get to the fraud chapter, because I'm going to make a statement that I would bet half of you guys are going to disagree with, but the PCAOB says it's the lay of the land. Okay, so another PCAOB standard, AS 2105, talks about materiality, but we want to answer these specific questions relative to materiality. Do auditors only consider materiality of an individual account or misstatements? Yes or no? Answer is no. We said that there is a cumulative effect. Last one is materiality only affected by quantitative factors. So non-quantitative factors can affect materiality. So is it only affected by quantitative factors? No. We also said that the nature of the issue can affect whether or not something's material. Think about it like this. You may have something that you've grown up with your childhood or something you're attached to now that may not have cost very much, but it means a lot to you. So the quantitative value isn't there, but the intrinsic value to you can be completely high. Tangent, but it's kind of similar to what we're talking about here. It may not be the dollar amount that makes something material. It could be that it represents a systematic issue, or well, it's hard not to talk about internal controls yet, but let's say that it's an issue that it's a mindset of a certain manager in the way that they run things, right? May not end up being materially impactful to the financial statements, but it affects the environment in which people work in. And so that can in turn affect production and other things. So it can end up being material because of the nature of the issue.